Okay, so health savings accounts. Health savings accounts are a type of, obviously, savings account that you can contribute to, I should say, if you have a certain type of health insurance plan. And the type of health insurance plan that you have to have is called a high deductible health plan. So health savings account, HSA, is paired with a high deductible health plan. So you can only make contributions to the HSA if you have, at the time that you have a high deductible health plan. You can take distributions from an HSA anytime. You do not have to have a high deductible health plan in order to take distributions. So contributions they require a high deductible health plan at the time of the contribution. Distributions, taking money out, do not require a high deductible health plan. So, I mean, for example, what I mean by that is if you worked for an employer and you had a high deductible health plan 3 years ago, you don't work for that employer anymore. You have another health plan, but you had an HSA that you contributed to. You still have money in that HSA. You can still take distributions from it, as long as those distributions are used for qualified purposes. You can take distributions from it if you're retired. That's fine, as long as they're used for qualified purposes. That money, the money that's contributed to an HSA is yours forever. It belongs to you. You carry it with you. Even if you're not at the employer anymore, you still have the funds that are in that HSA, and you can still use them even if you don't have that high deductible health plan. However, in order to make contributions to the high deductible health plan, to the HSA, at the time you have to have a high deductible health plan. For those who have high deductible health plans, know it. Like the insurance makes them aware, and usually they'll like offer, here are your options for contributing to a health savings account as well. So there are limits, and the reason for those restrictions are contributions to an HSA are deductible. And distributions are not taxable. So if you contribute to an HSA, say you contribute $2,000 to an HSA, and you meet all the requirements, that then reduces your taxable income by $2,000. That's a $2,000 deduction that you get. And then when you take the money out, as long as it's for the qualified purposes, so you use it for medical expenses, qualified medical expenses, you're not taxed on that money when you receive it. So remember I said that, you know, every transaction has two sides to it, has a deduction and a taxable part to it. This is one of those exceptions where you get the deduction, but you don't have to pay the tax when you use it, but you have to use it for the specific purposes that it's the specific purpose that it's designed for. So what happens is with a health savings account, also a lot of employers offer health savings accounts. They'll offer a high deductible health plan, and then in conjunction with it, they'll allow employees to contribute to health savings accounts. So the money is directly taken from their paycheck and put into the health savings account. And what that does is it shields it from both income tax and Social Security and Medicare tax. It's great. Best of all worlds. The only problem is with the high deductible health plans, they are what they say they are. They have a high deductible, which means that you've got to pay as the beneficiary of that health plan, you have to pay that first amount toward your medical expenses, and it's a high deductible. So it could be several $1,000s that you have to pay, and you have to pay that every year. It renews every single year. The purpose behind the HSA is designed to then, you've got funds to draw from to pay those initial amounts every year, right? But the deductibles can be quite high on those high deductible plans. So the Form 8889 is what's used when there are contributions or distributions from these accounts. Contributions are in Part 1, and it says HSA contributions, and it calculates the deduction that's allowed. This is filled out, so if it was through your employer, where is it here? Do not include employer contributions through a cafeteria plan. Those are on the W-2, and you don't list them here because you don't get a deduction for those. Instead, you don't pay the tax in the first place, right? What do I want to say about this? So there are limits. Whoops. There are limits to how much you can contribute to an HSA every year, but those limits go up every year. They're indexed for inflation. So I'm kind of getting ahead of myself here. So the contributions are calculated here. Distributions are listed here. If you take a distribution and you do not use it for medical purposes that fit the definition for these distributions, you pay tax on the amount you distribute. So if you take a withdrawal and you pay your rent with it, so you take out $1,000 and you use that to pay your rent, now you pay tax on the $1,000 plus a 20% penalty on it. So now your $1,000 rent cost you, well, at least the 20% penalty, but if you pay income tax as well, it's going to pay you whatever your tax rate is. So if you're in the 15% tax bracket, is there a 15% anymore? I think so. You're paying $150 plus a 20% penalty on that, so you're paying $350. So that's to discourage people from withdrawing it for non-eligible purposes. These are, so the 5498 is the form that is issued to anybody who, let's see, this is for contributions. So if contributions were made during the year, they are listed on this form 5498. If distributions were made, they are issued on a 1099 SA. So, and you can see there's the gross distribution. So if you received any funds so if you have an HSA, you made contributions and you took distributions in the same year, you're going to get both of these forms. One showing how much you contributed, the other one is showing how much you had distributed. Let's see. So this is the definition of a high deductible health plan, and it depends on whether you have individual coverage or family coverage. So if you have individual coverage, the minimum deductible has to be $1,600, maximum deductible $8,050. So you can see that's the amount that the beneficiary has to pay before the insurance starts to pay anything. So if you go into the hospital and you have a bill for $10,000 and your deductible is $8,000, you've got to pay $8,000. And then the insurance will start to kick in, and usually it's only a percentage of the additional amount that they'll pay. So the maximum, and this is different. This pertains to the deductible of the high deductible health plan. So this is the high deductible health plan part of it that is required. The contribution to the HSA part is limited to $4,150 for single, or individual coverage. And this is the part, these change every year. So the HSA limits, so for individual, if you have individual coverage, so $4,150, family coverage, $8,300. So this will be the maximum deduction that you get as well. Usually what they do is like you'll make the contribution to the HSA, And then let's say you go, you have a prescription that you pay for every month, and the prescription's $50 every month. You'll usually get like a debit card for the HSA account. Works just like any other savings account or checking account. You'll get a debit card, and then when you go to the pharmacy, you'll pay with the HSA card, and that $50 will then come out of the HSA. So you got a deduction for the money that was contributed, and you don't have to pay tax then on the money that when you take it out. So it's that double benefit there. But like I said, it has to be used for medical purposes. And you cannot pay health insurance premiums with HSA funds. So you cannot then pay for your health insurance. So qualified medical expenses. Let's see, what are they saying here? So distributions are tax-free if they are used for qualified medical expenses. The list is pretty expansive. I mean, even over-the-counter medications and stuff are considered to be qualified medical expenses that you can use then to pay for with HSA money. Employees are always 100% vested in their HSA. All the money, even if your employer contributes to your HSA, they can do that. They can contribute up to the maximum. It's not taxable to the employee. And that money then belongs to the employee, and they can take it with them when they leave employment as well. Okay? Questions about HSAs? So again, that's a 4 AGI, B4 AGI deduction. So it would show up on the Schedule 1, and it provides a tax benefit. It reduces the AGI as well for other purposes elsewhere on the tax return. So it's one of those areas as well where you've got some control over it. So if you are if you are right on the edge of being able to take the child tax credit, and by making a contribution to your HSA, it brings you under that phase-out range, you'll not only will you then get the deduction from you'll get the reduced tax liability from this deduction, you're also then going to be eligible for a credit. So it has a double benefit to you. So, and you, like I said, you got a measure of control over it as well. Some of these you don't really have a whole lot of control over.